Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. On Friday, Singapore released its Budget 2022 that includes a slew of higher taxes to redistribute wealth while improving resilience through healthcare spending and green projects. Meanwhile, foreign buying has returned to ASEAN markets. What sectors might continue to outperform and underperform as interest rates and inflation increase? Suhaimi Ilias, our Group Chief Economist, moderates this conversation across our teams in the region.
Hi, good morning, everyone. It's Monday, 21st February. And as usual, let's start with a roundup of last week. US and Europe stock markets ended last week lower, while bond markets fluctuated amid the risk of Russian invasion of Ukraine, as well as ongoing concerns on inflation and the implications on central banks' monetary policy. Contradictory signs from US Federal Reserve also fuel market volatility. We have a hawkish comment by St. Louis Fed President James Bullard, who expected as much as 100 basis point hike in US interest rate by July. This kind of contrasted with the somewhat dovish minutes of last month's FOMC meeting. I think as of Friday, futures market were pricing in 80% probability of a 25 basis point hike in March. Mixed US economic data may have also lowered expectation for an aggressive rate hike at the upcoming meeting. Weekly jobless claim rose for the first time in a month. The two regional manufacturing indexes surprised on the downside, but retail sales rebounded in January by more than expected and the most since last spring. Over in Europe, ECB president and a couple of the governing council members said any adjustment to European monetary policy will be gradual and data driven, but ECB chief economist suggested there may be a growing consensus for stimulus to be withdrawn faster than planned, as inflation is unlikely to drop below ECB's 2% target in the next 2 years because of higher inflation expectations. In UK, inflation reached a 30-year high of 5.5% in January, highest level since March 1992. Labour market tightened further there as jobless rate fell to 4.1% and average weekly wages grew 4.3% in fourth quarter, while the number of workers on payroll hit a record 29.5 million in January, and we are seeing labour shortages across many sectors. This contributed to increased expectation that Bank of England may announce a third interest rate hike in March. In contrast, I think China's equity market gained through last week on supportive comments from government officials and lower than expected inflation data. China's Premier Li Keqiang pledged that Beijing will swiftly roll out a slew of measures to provide for stronger support to the economy. China's top finance minister vowed for further corporate tax rate cuts and strengthen targeted fiscal spending, while PBOC said it will maintain a supportive monetary policy for this year. China's developers continue to highlight the financial troubles weighing on the property sector. Shimao Group asked for extension to pay back 6 billion yuan of high-yield trust products over 3 years. China court ordered the freezing of 640 million renminbi in assets held by a subsidiary of China's Evergrande. Enro Properties is the latest developers to warn it may not be able to meet obligations. And chairman of Vanke said China Properties' best days are over and the company is changing its business mix. Now in ASEAN, highlights included the tabling of Singapore Budget 2022 last Friday, and we have Bin and Thilan to discuss that. Meanwhile, Central Bank of Philippines kept interest rate at 2% at its first meeting for this year. That has been unchanged, I think, since November 2020 or December 2020. And we have Jacqui to talk about Philippines market implication of external and domestic monetary policy outlook. There will be release of Thai fourth quarter GDP today. Maybank Investment Banking Group is looking at 1.4%. Consensus is 0.7% growth after the contraction in third quarter. For this week, we will have flash February PMIs for Europe, inflation numbers for Eurozone, Japan, Singapore, Malaysia, and PBOC is setting prime loan rates. Just to recap, the 1-year prime loan rate in China has been cut by 10 bips to 3.7% last month after the 5 bips cut in December. There's also Bank of Korea rate decision. We already have had 3 interest rate hike by Bank of Korea since August last year to current level of 1.25%, which is already back to pre-COVID-19 level. We have Anand to give us a run through of ASEAN market. Joey will provide an update on latest macro development in Indonesia, followed by Willy. He will share with us his thoughts on Indonesia's retail sector. Once again, Ting will be on air today to brief us on plantation sector, and we will touch base on Malaysian gaming sector with Shao. Let's start with Harbin first. Harbin, on Singapore budget 2022 announced last Friday, how does it stack up against market and your expectations, and what are the key measures and takeaway?
Hey, hi, morning, Suhaimi. So yeah, budget 2022, I think focus on shoring up finance to meet the priorities for a post-pandemic future, especially given the growing healthcare spending with the aging population, spending the social safety net, and transitioning to a green economy. I guess this is still part of the move for Singapore to what I see as a high wage but a high cost society. And I think overall this budget actually gives a lot less support for businesses. It focuses more on redistribution, lifting the lower income households, and it's really the, I guess, higher wealthier and higher income tax brackets which will be funding part of the redistribution. So the GST has been delayed to next year. It will go up to 8% on 2023. It will go up to 9% in 2024. So I suppose that's a plus in the sense that it doesn't aggravate the inflation pressure. We're looking for headline inflation to actually reach 5%, by the second quarter. There'll be a 6.6 billion assurance package, so higher than the earlier 6 billion, and that will help to offset some of the impact on the lower income households. The 2% GST hike, when it's fully in place by 2024, will raise about 3.8 billion, so substantially more. When you compare the wealth tax on cars and properties and the personal income tax bracket, all that only raises 600 million, just to put in perspective. So that's a plus. The wealth tax, I think, was to be expected. It hurt on property annual values. It will hit both owner-occupied and especially investment or non-owner-occupied residential properties. And it'll be raised in 2 steps from 2023 to 2024. For owner-occupied, it really hits only the top 7%. Luxury cars, again, expected, hitting those with open market value in excess of 80,000. So your Lamborghinis or your Bentleys will pay much higher prices. The personal income tax, I thought it would come later, but I guess the government has decided to announce that it will be raised with effect from year assessment 2024. So the highest bracket will be raised to 23% for income excess of $500,000 to 1 million, and for those earning 1 million, they will have to pay 24%. Bear in mind that this only affects the top 1.2% of personal income taxpayers and will raise an additional 170 million. The carbon tax was expected, but the increase was a lot sharper than I think many of us anticipated. So it will be going up from $5 to $25 in 2024, so up 500% for companies that emit at least 25,000 tons of greenhouse gas annually. And it's going to go up to $45 per ton in 2026 and 2027. And it's going to go up again to 50 to 80 per ton by 2030. So that's a pretty steep increase. It pretty much brings Singapore in the top quartile, along with some rates seen in South Korea and the UK. The $25 per ton increase will translate to increase about $4 per ton in utility bills for an average 4-room household. But the government will not impose additional carbon tax on the use of petrol, diesel, and compressed natural gas, as these are already covered by excise duties. Bear in mind that the carbon tax is not meant to raise net revenue, because all the new money will be rechanneled into investments into new low carbon and more energy solutions. The government gave a heads up on corporate income tax system on the back of this minimum global tax, which could be effective from next year. So if that materializes, there will be a top-up tax called the minimum effective tax rate to bring up the MNE effective tax rate in Singapore to 15%. Bear in mind that in our studies, we find that the US MNCs are only paying an effective tax rate of about 4%. So there is a considerable potential increase in the revenue. Of course, there will also be a negative revenue impact under what's called Pillar 1, where the profit will be reallocated to where activities are conducted to and where consumers are located. So it's still not quite sure what the net fiscal impact on be, depending on these two offsetting portions. Overall, there could be some negative impact on Singapore's attractiveness as an MNC hub if you cannot offer lower tax rates. The big surprise to me was the further tightening of foreign worker measures. So I see this as negative. I would have thought that, given that there's been an exodus of EP passes and S passes over the past 2 years, that the government will try to relax because there are some scheduled quota increases and levy increases later this year. But essentially, the government gave a new parameter that EP holders' qualifying salaries now will be pegged to the top 1/3 of local professionals. S pass holders are similar as well, comparable to the top 1/3. These qualifying salaries essentially will be raised over time. For this year, for 1st September, the EP pass holders' minimum qualifying salaries will go up to 5K. For the financial sector, it will go up to 5.5K. And then for S pass holders, it will also be raised to 3K this year from 2.5K. And then for financial sector S passes, 3.5K from 3K. It's tougher for SMEs to get foreign workers. So for those who are very dependent on foreign labor, will feel the pinch, and it might encouraging more outsourcing of some of the lower end jobs. There's some expansion of social safety net. There will be the progressive wage model that will be expanded to retail, food services, and waste management sector over the next 2 years. In September this year, there will be the minimum local qualifying salary of $1,400 per month that will be introduced for companies employing foreign workers. But the government has tried to help with the transitional support. It's providing a progressive wage credit scheme, which will co-fund some of the wage increases. And the co-funding rate will be gradually tapered over time. There will be also the enhancement of the workfare scheme. It's something that's been around for quite some time, and that will help the payout for the lower income workers. CPF contribution rates will also be raised for those who are older, aged 55 to 70. They'll see about an increase of 3 to 4 percentage points in their CPF contribution rates over the next 2 years. So overall, I think the business support part, I think speaking to some businesses, they're kind of disappointed because I guess after 2 years, they're so used to such general handouts. Remember that the job support scheme, dispersed about 28 billion over the last 2 years, and pretty much this is winding up. There's a 500 million job support scheme this year, but compared to the scale, that's a lot smaller, and of course that's a lot more targeted now to F&B, retail, tourism, hospital sectors that are still struggling. So overall, we just raised our inflation forecast for next year, given the GST timing, 1.8%. No change to the inflation forecast this year, but again, the government also designed such that some of the inflation impact will be partly offset. There'll be a freezing of government fees and charges next year on school fees, parking charges, license fees, and then the government is also doubling down on the GST vouchers, which kind of offsets some of the utilities impact in some of the months, April, July, October, January. We're maintaining our growth forecast, 3.8% this year, 2.5% next year.
Harbin, as a result of this budget, will there be implication to mask policy in the coming April review?
We don't think so. We think that given that inflation will still be rising in this few months and probably peaking in the hopefully second quarter, that they'll be still forced to tighten again, but probably through a recentering of the band. So we expect essentially a 2% upward move in the nominal exchange rate. The Sing dollar is hugging the top side of the band. So yeah, we're expecting a further tightening.
Okay, thanks, Harbin. Let's move on to Thilan. Given the budget 2022's details shared by Harbin just now, what's the market impact? In particular, how and where do you see the budget having positive, neutral, and negative effects on Singapore stocks?
Morning, Suhaimi. I think it's largely neutral for the market. As Harbin said, support for businesses has been reduced, but I also think that downside risks have been lowered. One of the key risks we had for the market was asset quality. The extension of the support schemes for COVID vulnerable sectors, especially in the SMEs, will help take some of the edge off NPL risks for the banks. At the same time, there's a lot more support being given for M&A and corporate restructuring. which will help things like fee income as well as market volumes, which is good for SGX. The delayed and staggered implementation of GST reduces some of the structural inflation risks, and it actually may support some of the retail spending in the near term. So stocks like Hourglass, Cortina, some of the retail REITs could actually benefit. Some of the increased investments in next-gen infrastructure will be positive for the telcos, particularly names like Singtel, StarHub, and Netlink. Now, the tighter labor measures will cut across all sectors, but I think the bigger impact will be areas like industrials, consumer, and property, where there is a higher proportion of foreign labor dependency. But I think also the added focus on sustainability, especially in terms of transition for sectors like aviation, tourism, marine, will actually provide some upside for these sectors as well. Back to you, Suhaimi.
Thanks, Thilan. Just move on to Anand on ASEAN markets. I mean, generally, ASEAN markets have been year to date, and despite all the volatility globally, amid concerns about monetary policy directions, inflation, geopolitics, is the positive in ASEAN markets that has been showed so far this year a flash in the pan, or there's more upside coming? And just want to know whether are there any material changes to our ASEAN market strategy as well as sector calls and stock recommendations?
Yeah, whether it's a flash in the pan or not, the mood is definitely quite upbeat for ASEAN markets for a change. I think when you look at the regional benchmarks, they continue to outperform both on a relative and absolute basis versus their global peers. And a lot of this, is due to a combination of very positive factors which are happening right now. One is a general backdrop of a preference for switching into value from growth. Over the last couple of years, ASEAN has really underperformed because the benchmark indices and the markets themselves are very value oriented. Not much growth or tech representation, but that's working in ASEAN's favor at this point as people look for markets which have been underperforming, which have value to play into a cyclical recovery, and which are relatively insulated from the issues facing more developed market, which you covered earlier. But also supporting the optimism is the fact that 4Q reporting has been quite resilient across the region. So that's really providing a lot of impetus to buying into oversold markets. I've also seen sentiment lifted by accelerated economic reopenings and also rising foreign inflows. We haven't really seen a return of foreign inflows into the region for quite a while, since the pandemic started actually. But year to date, we are seeing a good recovery in net buying by foreigners. And I think that's also the value defensive attraction of ASEAN coming through. Some of the key sectors where they are focusing on, financials is a big one. I think that's an easy one as well because values are there. And also we are looking at the rate cycle changing, which will be good for the banks. But also energy, commodities, and plantations are also seeing some decent buying as well.
And it looks like you're referring to those sectors like bank and commodity related that will benefit from essentially interest rates and inflation. Are there sectors within the region that you are advising investors to be cautious?
Yeah, I think on the positive side, the trend among our analysts is still on the optimistic side or the upside. So, the last 2 weeks, we've initiated with buy ratings on 2 stocks, Hibiscus, an oil and gas play in Malaysia, as well as Capital Land Investment in Singapore, which is a real estate investment management company. We have also upgraded SGX, Robinson's Retail in the Philippines, as well as Globe Telecom in the Philippines as well to buy. So those are the key changes, and you can see they're all positive. But if we were talking about downside risks, high interest rates really would be a bit of a drag for companies which are highly geared or which have a very geared or leveraged business model. The REITs do come to mind. We get more questions now whether REITs are still going to perform in a rising rate environment. Generally, they tend to underperform in a rising rate environment. But given where yields are right now for many REITs in the region, in the 5 to 6% range, compared to risk-free rates of 2 to 3%, there's still quite a big buffer. And as our economics team has mentioned, we don't expect as steep an interest rate cycle in ASEAN as we do in developed markets. So we still see some value in REITs despite that downside.
Thanks, Anand. Let's move on to Indonesia. Jacqui and Willy with us today. Let's start with Jacqui first on macro. We had releases of Indonesia's exports, imports, and retail sales data last week. So how are external trade and domestic trade doing? And what's the outlook amid export curbs on commodities like coal and palm oil, as well as the rising Omicron-driven cases of COVID-19 over there?
Hi, morning, Suhaimi. So Indonesia's exports growth decelerated to 25% in January from the above 30% pace in previous months. And this was weighed down by export restrictions on commodities like coal, palm oil, as well as Ting. This resulted in trade surplus narrowing to just $930 million in January. That's the smallest since April 2020. Coal exports plunged by 34% because of the export ban. But we do expect it to recover with the lifting of the ban starting 1st of February for around 200 out of 600 miners that have complied with the domestic market obligation rules. But exports may not return to last year's levels, given the tighter regulations that require firms to report their DMO fulfillment data on a monthly basis compared to the previous annual reporting. For palm oil, we expect growth to turn negative in February following the recent export rule that requires companies to allocate 20% of shipments to the local market because of the spike in domestic cooking oil prices. Most exporters are expected to adjust their volumes and comply with the rule by March. On domestic trade, retail sales stayed resilient, rising by 16% in January, while consumer confidence index has also firmed despite concerns over Omicron. The recovery for retail sales was led by fuel, food and drinks, as well as apparel. Domestic demand will likely be more resilient compared to the Delta wave, given the higher vaccination rate for Indonesia. And people movements to retail and recreation venues are staying above pre-pandemic levels, despite the spike in COVID cases and the tighter mobility restrictions that were imposed since 7 February.
Thanks, Jacqui. Willy, you are neutral on Indonesia's retail sector. This is despite our macro team forecast of consumer spending growth accelerating to 6.2% this year after a moderate 2% rebound last year. So what's holding you back from turning positive?
Well, hi, good morning, Suhaimi. So basically, our view is that while we expect that consumer spending to be more resilient this year, we think this has to do with the fact that most of the retailers in our coverage sells discretionary goods. We think that the main beneficiary of the consumer spending rebound is the one that sells the primary or basic goods. And this is reflected by our expectation on earnings recovery, where we see higher visibility for the recovery on the higher end segments rather than on the mid to low segments. And the ability for the company to reach back its earning to its pre-pandemic level will depends on two factors. First one is on market segmentation, and second one is on the cost structures. We believe that the retailers that segments a high income customer will have a visibility to gaining back their earnings to the pre-pandemic levels, and also the company with a very flexible cost structures will be able to mitigate the negatives from the rising wage costs in Indonesia. We see there are two names in our coverage, namely Ace Hardware and Mitra Perkasa, that have very good cost structures and their ability to weather the negatives on the wage inflations.
Thanks, Willy. Let's bring in Ting. Ting, you revised your CPO forecast, obviously factoring in the surge so far this year to well over 5,000 ringgit per ton, but your full year forecast implies price will correct from current lofty levels. So first, why are the factors driving up prices so far this year? And why do you see correction? And what does that mean to the current run up in the plantation stocks?
Hi, Suhaimi. Firstly, CPO's fourth quarter output last year fell short of market expectation, especially in Indonesia, and we are currently into the seasonally low production cycle. Secondly, South American crop harvest prospects have deteriorated sharply over the past 2 months due to the drought experienced in the southern part of Brazil and Argentina on the La Nina phenomenon. Thirdly, crude oil prices have surpassed $90 per barrel, in part due to geopolitical tensions. Fourthly, Indonesia's latest export policy announced on 27 January requiring exporters to set aside 20% of the industry's export volume for domestic market obligation has raised some concern over the availability of palm oil in the global market, at least in the short term. In addition to earlier factors, the labor shortages in Malaysia persisted and gotten worse by the days as foreign workers have yet to return since the promise was made in October last year. In summary, the key message was that the recent CPO price rally was simply a supply crunch in the global market of late. Likewise, as and when supply recovers, CPO price will correct. We believe there will be price pressures when supply recovers, especially in the second half of this year. Palm oil will enter into seasonal peak production period in second half. In addition, we believe US farmers will prefer more soybean planting to corn, as the soybean-corn price ratio has recently tilted in favor of soybean. From a cost perspective, soybean requires less fertilizer compared to corn. This may be an important deciding factor for US farmers this season, which will kick off in April. If farmers do plant more soybean and assuming a favorable weather condition, supply of soybean will be ample come September or October this year. The current model forecasts La Nina to end by mid-year and return to an ENSO neutral condition. As for demand, the present high prices will likely lead to some demand destruction, especially those of price-sensitive consumers. We have also seen some countries such as Brazil and Thailand cutting back on their biodiesel blend mandates. Now, the current run-up in plantation stocks have been a refreshing change from the past 12 months. At least now the plantation stocks are trying to catch up with CPO prices. I think in this brief plantation stock bull market, a bull rally that we have seen so far, the momentum may continue or even overshoot in the short term. I don't know how long the current run-up will end, as there is a wide range of CPO price forecasts out there in the market, and even how long this commodity bull will last. But I do think that CPO price will likely peak in first quarter of this year if La Nina is over and the normal weather returns by mid-year. And over time, equity stocks will revert to a more sustainable or normalized level, reference against a more normalized CPO price.
Let's move on to Jacqui. Jacqui, Philippine Central Bank kept interest rate unchanged at 2%. Our house view is for 25 basis point hike fourth quarter of this year, which is like well after US rate hike cycle begin, expected next month. Will the market be significantly affected by US and domestic interest rate hikes, in the sense that, from your thoughts, which sectors and stocks will be winners, losers, and sheltered?
Hi, good morning, everybody. Good morning, Suhaimi. So from a fundamental point of view, the US Fed raising their rates should have minimal impact on the Philippines. So aside from the minimal correlation the US and the Philippine macroeconomic landscapes have, inflationary pressures in the Philippines can actually be addressed by supply measures instead of rate hikes. So this is consistent with our central bank stance of remaining accommodative for as long as inflation is actually within the target 2 to 4% range. Nevertheless, we ran an interest rate sensitivity analysis across the stocks under our coverage. And what we found out was a 25 to 50 basis point rate hike implemented today basically only reduces our 2022 earnings forecast by about 1 to 2%. This is largely because variable debt to EBITDA remains low at sub 2.5 times. From a sector perspective, a clear winner in this would be the banks, since approximately 70% of their loan books have variable rates. They are able to pass on this rate hike but maintain costs low given their wide and growing CASA base. Property developers and property-led conglomerates would be most impacted as they have the most leveraging. But even so, we're still looking at about 2%, a 2% cut, mainly because Close to 70% of their exposures have fixed rates, and approximately 80% are long-term in nature. Finally, consumer and REIT companies in the Philippines would be the least impacted given their cash positive positions.
Thanks, Jacqui. Let's move on to Xiaoyang. Gaming has been hard hit and kind of struggling to recover from the pandemic. But with this surge in Omicron-driven COVID-19 infections in Malaysia since early this month, are we looking at yet another blow to the industry recovery prospect, Xiaoyang?
Hi, Suhaimi. This time around, that may not be the case. I mean, the government has already promised that there won't be any more full-scale lockdowns anymore. But even if there are no lockdowns, it seems to us that retail and recreation in Malaysia is still resuming as usual. We looked at the Google Mobility Retail and Recreation Index for Malaysia, and it looks like things haven't changed very much since the Omicron wave began about 2 weeks ago. Now, we suspect this has got to do with the Omicron variant's low fatality rate. And actually, it shouldn't come as a surprise to us because we studied the experience that the US, UK, and Australia went through about, their Omicron wave started about 2 months ago. And it looks like their own retail and recreation index, as measured by Google, is also not very badly affected, and we think it's due to the low fatality rate. In short, this basically means that people are still willing to go out to do retail recreation and presumably gambling, despite the risk of being infected with COVID, as long as the fatality rate is low. So we're still looking to a recovery year this year.
Thanks, Xiaoyang. I guess the game is still on. We will have a Zoom session with Harbin and Thilan on 25th February at 12 p.m. to discuss more on Singapore budget. If you are interested on that, do look up for the details. And that's it for today. Thanks. Bye.
Speak to your trading rep at Maybank to get specific investment advice and for the research mentioned. Also, sign up for our webinar with our analysts on Singapore Budget 2022 and market strategy this Friday, 12 p.m. Have a good week ahead. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.